10 megatrends that should excite investors. My name is Brian Feroldi.
And my name is Brian Stoffel.
Brian, what is a megatrend?
A megatrend is a long-term change, and it's the type of long-term change that affects everything, everything in government, society, economies, our daily lives, and it does so permanently. And sometimes it can take a long period of time for that trend to unfold. But it's one that once you go down that path, there's no going back.
And history is filled with examples of megatrends. Sometimes they're driven by innovations such as the railroad or the automobile or communications or even the microwave. There has been countless innovations throughout history that just permanently change society for the better.
Now, the way that these megatrends actually occur follows something that we like to call the S curve. And this is very well known in certain industries, but through that first stage of infancy, it can seem like the adoption of a new technology is painfully slow. Years can pass by and almost no one is paying attention to it. And then it hits an inflection point where all of a sudden, usually because something that was once very expensive all of a sudden becomes affordable for the masses, it goes through rapid expansion until you get to the maturity part. The key for us here as investors is if you get in on a technology or a mega trend at the infancy or the beginning of the expansion phase, it can have huge returns for your portfolio.
Yeah, and just to be clear, not every megatrend is adopted on an S-curve, but if you look at some of the disruptive technologies that were innovated throughout history, all of them were adopted on an S-curve. Some examples dating back more than 100 years ago: the telephone, electricity rates, radio, air travel, video games, HGTV, even smartphones and tablets. All of them were adopted using by following S-curves. And actually look at this wonderful chart. The rate of adoption is actually accelerating. So products and services that are disruptive are being adopted by society even faster than I have been historically.
Now, importantly, just because you've identified a megatrend does not mean that you will automatically get great returns. Someone will benefit from the megatrend. Sometimes it's the end users, sometimes it's the employees, and sometimes it's the investors. That's why it's important that we dig deeper than just looking at what the megatrends might be.
One of the biggest megatrends over the last 15 years have been solar panels. If you look around, their odds are very good that 15 years ago there were no solar panels, and now they're all over the place on lots of people's rooftops. But if you saw that megatrend, you would think, well, solar panel manufacturers must be great investments. If you look at the long-term histories of some of the leaders like First Solar, SunPower, or Renee Solar, their long-term returns have been terrible. Why is that? How can that be? That's just the nature of the solar panel industry. They're making hardware, so they have relentless pressure on them to lower prices, lower prices, lower prices. So all the volume gains are captured by society and consumers, not by their investors. Now, this doesn't mean that all solar companies have been bad investments. If you look more recently at Enphase Energy and Solar Edge Technologies, which makes components for solar panels, specifically inverters, these companies have established much stronger moats for themselves, and they haven't had near the amount of pricing pressure that those solar panel makers has. As a result, they've rode the solar panel wave beautifully and produced wonderful returns for investors. So the key thing you need to think about is not just how important or how big is this megatrend, but will investors be capturing the value that is created?
Exactly. And that word moat is going to be really important as we go through these 10 megatrends. So let's kick it off. And again, this is not an exhaustive list. There are tons of megatrends. These are just 10 that we identified as worth showing people about. So the first trend is esports. What is esports? That E is just electronic. It is video games. And importantly, it's not just playing in video games, it is watching others play video games. It is taking video games and turning them into a professional league, much the same way that baseball turned into Major League Baseball or American football became the NFL. You might be surprised this is really gaining steam. If you aren't involved in it, I wouldn't blame you for being unaware of it.
My son and all of his friends are huge fans of video games, and they really like to watch other people play video games because they do so at a high level. And if you look at the opportunity that exists for esports, in 2020, the esports industry rang up about $1.5 billion in sales. According to Grandview Research, that number is going to be about $7 billion within 5 or 6 years. Now, importantly, these are just estimates, but it does show you the magnitude of the opportunity that exists.
Exactly. And we're going to give you the names of some of the major players. These are not stock recommendations. And again, this is not an exhaustive list, but the companies that we have listed here, they're major players in the industry. They either develop video games, they develop a platform for others to develop video games, and they're located in different geographic regions of the world. So they're all names that you can look at if this is a megatrend that you're really interested in.
Now, when it comes to assessing the viability of this, again, we have to think as investors. So the thing we have to ask ourselves is, what possible moats could these companies build for themselves? And we think there's really three to focus on. The first would be brand. The brand of the video game or the brand of the video game company can matter. Two would be the switching costs. Once you start playing a game and learn and go down a process, it can be onerous to switch to a different game. And then three would be the network effects. The more users there are on some video games, the more attractive it is for other users to join that game.
So how do you check and see if these are actually in play, if these moats are real? Well, there's no one size fits all method. Each company will have different metrics you need to watch. But in general, if you're looking at brand value, you should see revenue growth. You should see more users coming to the platform, and you should see a smaller percentage of the gross profit or revenue or whatever you choose. A smaller percentage should be used on sales and marketing because they don't need to have sales and marketing. Their brand is so strong. For high switching costs, some gaming companies will break out in-game purchases and the average playing time of users. You want to see that moving up. And for network effects, what really matters is either the number of users on the platform or the users and the developers who are making games for the users, because the more that come, the more incentive there is for others to join that platform.
All right, Megatrend 2, plant-based meat. This is when companies take plants or homegrown materials and use that to make artificial meat. This is a trend that is growing and is expected to grow rapidly over the next couple of years.
And to show you to keep these different megatrends in perspective, we're going to put the most recent one on the right and past ones on the left. Again, these are just estimates. But Grandview Research says last year, roughly $4 billion was spent on plant-based meat. That shouldn't be too surprising if you've been paying attention. It seems like everybody's coming out with their own version of a plant-based burger. But that doesn't mean that the market is tapped. In fact, they believe that within the next 7 years, we're going to see almost $14 billion being spent on plant-based meat. So there's huge room for growth here.
There are a couple of companies that are focused exclusively on that, such as Impossible Foods, which at the time of this recording is not public. There's also Beyond Meat, which is a publicly traded company. And then a lot of other big companies have divisions that are also focused on plant-based meat. Again, this is not an exhaustive list of all the companies that are out there. These are just some of the major players.
But with this, probably more than any others, where I'm a little bit pessimistic about the investability of this because I'm not sure about the moats. The moats that need to exist are the brand value of whoever is making this plant-based meat, low cost production. If they can make it for less and sell it for the same price, that's great for them. And distribution. You got to be able to get the package from point A to point B quickly.
And to judge the viability of these moats, you need to look at things like revenue growth, their distribution agreements that they have, any partnership agreements that they have in place, as well as how much they're spending on sales and marketing. Building a brand in the plant-based meat space is going to be expensive. So companies that can spend more typically can build a strong brand name for themselves. As for the low-cost production, keep an eye on gross margin. If a company is selling a product in the market at the same dollar price as a competitor, but it drives a higher gross margin, that means it's producing it at a lower internal price. And then finally, for distribution, some companies will tell you the number of stores that they're in or the number of retailer outlets that they're focused on. The more, the better.
All right. Megatrend number 3, autonomous vehicles. Autonomous vehicles, it just means that magical place in the future where you can read a book on your commute to work and you're in your car, or you can take a nap as you drive across the country.
Now, the opportunity for autonomous vehicles is just enormous. And in fact, this could even dramatically understate the long-term potential of the technology. But according to Precedence Research, the autonomous vehicle market was worth about $3 billion in 2020, but that's expected to grow to almost $97 billion by 2027. Obviously, there's a lot that goes into that assumption, but it just shows you how big of an opportunity this could be for investors.
Now, there's so many different ways to play this trend because there's so many different technologies that need to come together. You've got auto companies like Tesla, obviously, is a name everybody knows about in this realm, but you can also think about the other car makers and even Uber. And on the other side, you've got the chip makers, the people that have to make the technology that makes this happen, like NVIDIA, AMD. Again, not exhaustive, but these are some of the names that you can investigate if that's interesting to you.
There are really four areas where a company could develop a competitive advantage in this market. One would just be the network effect. For example, Uber is the most popular ride sharing app. That means that it's going to have the most cars available where you are. That makes it the first app that you're going to go to if you want to get one of these taxis quickly. So the company that is first to market and builds out the biggest network fastest is going to have a massive competitive advantage. Then there's also things to consider like brand value of the company, or once you get this app installed on your phone and become used to it, maybe there could be some switching costs for you. Finally, would be the intellectual property that these companies own that makes the technology work just for them. That could be a valuable moat for the company in the future.
There's a lot of moving pieces here, but if you want to find out the network effect, really simply, you got to look at the number of riders and cars, basically the availability of the service in a given area. For brand value, we're focused more on the car companies themselves, and we look at their revenue growth and their sales and marketing spend. Again, Tesla, great example, spends almost nothing on sales and marketing. Great brand value. Next, high switching costs. There can be high switching costs within the app, but there also can be high switching costs in so much as once a car company devotes itself to an AMD or an NVIDIA or whichever chip maker they've got to provide the technology for that autonomous driving, the switching costs are going to be really high there. So you can pay attention to those agreements. And then there is intellectual property. Certain companies are going to reach certain levels of autonomous driving before others. And if they protect their trade secrets really well, that also can be an advantage.
All right, megatrend, digital payments. This is using electronic methods to pay for goods and services. And this is a trend that has been happening for years, but believe it or not, we're still in the early days here. Tons of people around the world are still paying for things with cash and check, and the opportunity ahead of digital payments is just massive to take share.
How big of an opportunity? Well, according to Grandview Research, again, digital payments had a market of about $68 billion last year. And that's not the amount of money that changed hands through digital payments. It's just the amount that could be made offering digital payments. Grandview believes that by 2027, 2028, we're going to see 236 billion or a quarter of $1 trillion available for the leaders in digital payments.
Now, as for playing, there's a number of companies that are focused on this, and to be frank, more are coming to this space every day. But as of right now, the major players in this space are companies like Mastercard, Visa, Square, PayPal. And there's also regional players that are highly focused on one part of the world, such as C Limited in Southeast Asia, Alibaba in China, Tencent in China, and Mercado Libre in Latin America. You could also play this trend by investing in cryptocurrencies, like many people have, such as Bitcoin, Ethereum, or any of the other dozens of cryptocurrencies that are out there.
So, what are the moats here? There's really two of them, and they're really easy to understand. High switching costs. I know when it comes to banking, I haven't switched to bank in almost 20 years because it's just a pain to do it. Once you trust someone to do your payments, you don't switch. And the other is the network effect. You want to have some type of payment option that will be available everywhere you go.
So how do you judge whether these moats are growing? Well, with the switching costs, look at the usage of their products. Some companies will tell you how often their products are being swiped. Another thing to look at would be user growth. The faster that your user growth is, the more those switching costs are getting built in. As for the network effect, keep an eye on the total payment volume. That's the total dollar amount that is flowing through a company's network. If that number is growing at an accelerating rate, there's a chance that the network effect could be in play.
All right, our next mega trend is streaming. And you see Netflix here. So we are talking about video, movies, TV show streaming, but we're also talking about audio streaming for music and podcasts.
The opportunity here might be even bigger than you possibly think. So in 2020/2021, the revenue that was earned by companies in the streaming market was about $84 billion, but we're still in the early days of the transition away from linear towards streaming. And Grandview Research believes that this could be a $300 billion revenue opportunity by 2027.
Now, when it comes to the major players, none of this should be surprising. You've got Netflix, you've got Disney and Disney Plus, you've got your Amazon Prime, even Roku and Comcast's Hulu, but you also have the audio and the podcast via Spotify, which is it's important that you keep an eye on that because some people forget about that when we talk about streaming.
So how can these companies build a moat for themselves? Well, there's a few different ways. One would be the brand and the brand value. And that not only extends to the names of the companies like Netflix or YouTube, but to the shows that they produce. If they can produce high quality shows that get a lot of buzz, that can provide a moat for the company. The second would be by creating switching costs. Once you sign up for these services and get you and your family used to using them, it becomes a bit of a challenge to get them off of your credit card. And but lots of people just forget that they're subscribed. That provides these companies with consistent recurring revenue.
Yep. And like you said, that award-winning content's really important. You look at Spotify, they went out and paid millions of dollars to get Joe Rogan's podcast exclusively on their platform. You can also look at sales and marketing, because if you've got a show that's a big hit, usually you can pull back on that sales and marketing because that show in and of itself sells the company. And then with those switching costs, I agree with you, Brian. A lot of times these are priced low enough that it's kind of a set it and forget it. You give me your credit card and that's it. And you need a really good reason to go through the pain of canceling. So just following subscriber growth can let you know that those high switching costs are in play.
All right, another mega trend we think you should keep an eye on is augmented reality. This is the use of technology, primarily glasses or goggles, to augment or enhance your current reality. This could be looking through them to get additional information, and you could also throw some virtual reality products in here.
Now, it's really tough to get a feel for how big this could be, but Grandview tried to do that, and they said it was worth about $41 billion last year, but they see this increasing 10x within the next 7 years. That is an enormous opportunity.
Yeah, and with any of these estimates, it's really important to keep in mind that these are just estimates and they are almost guaranteed to be wrong. It's really the trend and the long term that investors should focus on. But who are the major players here? There's actually several ways that investors can play their trend. Not only can you play it with chip makers like NVIDIA or Qualcomm, you could play it with companies that produce software that could utilize AR and VR like Autodesk and Alphabet and Unity software, or you could make it with the hardware companies such as Apple, Facebook, Snapchat, Nintendo. And there's also companies that are more niche markets that are using AR technology to make their products even more attractive, such as Wayfair and Etsy.
So what kind of moats can these have? Well, depending on which side of the chart we were just on, it can be brand value, which it means that if you just have a product that is very high brand value, people will buy it. A lot of people talk about Apple potentially making an AR, VR product. We already know people pay up for that. There's also network effects and high switching costs.
How can you tell if these things are going in the right direction? Well, with the brand, keep an eye on the gross margin line, as well as how much they're spending to really develop that brand name. Apple has defended its moat by creating a very strong brand for itself. Two, as for the network effects, some of these products will have network effects going for them, where the more users there are in the product, the more that will attract other users. So keep an eye on user growth. As for the switching costs, think about the product ecosystem. Do the products that the companies produce work together and make each other product more better, or are they completely separate? And then finally, think about the chip makers themselves and the product manufacturers. Sometimes if a chip is one in a design, it becomes really hard for a company to switch away to an alternative.
All right. The next mega trend is online advertising, or any type of advertising that isn't broadcast to huge populations all at once, regardless of who you are, the same way that linear TV and radio work. Instead, we're talking about ads that are tailored just at you.
Now, the opportunity for digital advertising is just enormous. Even in 2020, there was still a substantial amount of money that was devoted to advertising non-digitally. So there's still a lot of market share to be taken. And if you look at what Allied Market Research believes, they say that the digital advertising market was about $1/3 trillion in 2020, and that is expected to triple to $1 trillion by 2027.
It's a big number. Who are the big players here? There should be no surprise that Alphabet and Facebook are at the top of the list because they have so much data and they can use that data to offer targeted ads. But other social media plays you should also consider, like Snap, Twitter, Pinterest. Roku does a great job of monetizing people that use their service, their platform to stream free TV, and they use advertising for that. But then there's also those who aggregate and help make digital advertising, help that whole machine run really well, like the Trade Desk. But again, there are many other players in the space as well.
How can you tell if these companies are building a competitive advantage? Think about network effects, think about switching costs, and think about the brands that these companies are developing along the way.
So If you want to see if the network effects are at play, especially with those social media companies, look at the users, because more people that join, the more incentivized you are to join. You don't want to miss out on the conversation. Then there are switching costs. There are different features of the platform that you can only get in one place and not another. And finally, there's brand value. All the companies that we already talked about, some of them have the highest brand value in the world, and it's no mistake that they also have a ton of data that they can then use to make online advertising more effective for companies that want to run ads.
All right, the next mega trend is cloud computing. This is when companies take software that is run locally on a machine or on premise on an actual physical server that exists on the campus of the building, and they move that to servers that are in the cloud. This is a trend that has been happening for years, and there's plenty of reasons to believe we're still just getting started.
One of those reasons to believe we're just getting started is the fact that even though we spent about $310 billion on cloud computing, again, according to Grandview Research, they're expecting that to quadruple over the coming years to $1.25 trillion. And when you think about all the different ways that cloud computing can work, it actually shouldn't be that surprising to see such a big number.
This is a space that has so many players, it's really hard to come close to naming them all. But when you think about the really big companies that are taking advantage of this, the usual suspects are there: Amazon, Microsoft, ServiceNow, Salesforce.com, and even some of the companies that provide analytics or make cloud computing better, such as Snowflake, Datadog, Equinix, which is a company that provides the real estate data centers themselves, and companies even like Twilio that take advantage of cloud computing. Again, there are so many companies that are in this space. This is just a few, but man, is this a big opportunity.
And as we said many times, that won't matter unless these companies have a moat around them. But there are lots of different forms that these moats can take. And it's one of the reasons that this is the one mega trend that I know I am personally the most invested in. And the things that you can look for are network effects, high switching costs. Once companies start using this software, they don't want to switch, low cost production, and intangible value, especially via brands.
How can you tell if these things are going well? It's things we've been saying this whole time. With network effects, check the users and think about how the users interact with each other. For switching costs, there's a metric that a lot of software companies report called dollar-based net revenue retention. This is a figure that shows same customer spending from year to year. If that number is over 100%, they're getting more revenue from their existing customers each and every year. As for the low-cost producers, keep an eye on gross margin and just the general scale of the business. And then finally, with intangibles, take a look at the value of the brand and how hard it is for a company to acquire customers. If they have to spend a ton to get customers in the door, that's not good. If they spend very little to get customers in the door, boy, is that fantastic.
Next megatrend, we're calling it healthcare 2.0. What does this mean? It can mean so many different things: biotechnology, gene therapy, but it can also mean things like medical devices, like minimally invasive surgery. It can also mean things like telehealth, something that became really important over the past 12 months as the pandemic set in.
The healthcare market is absolutely enormous today. Global spending on healthcare was more than $8 trillion. Yes, trillion dollars in 2020. But if you play that number forward, there are going to be more than about $18 trillion spent on healthcare globally by 2027, according to Statista and Health Affairs. Now, that number is so large, and that captures all healthcare spending, not just next generation healthcare spending, but it just shows you how massive the healthcare market is. Now, healthcare 2.0 is such a massive and broad topic that there are hundreds of companies that you could potentially invest in, but some of the major players in this industry are companies like Intuitive Surgical, which makes robotic surgery systems, Illumina, which provides DNA sequencing machines for use for genomic analysis, Edward Life Sciences, which makes medical devices, Regeneron Pharmaceuticals, which makes next generation biotechnology, Align Technology, which makes the Invisalign system, Viva System, which is a cloud company that caters to the needs of life sciences companies, and Teladoc Health, which makes telehealth solutions. Again, this isn't anywhere close to an exhaustive list. This is just some of the major players that are participating in Healthcare 2.0.
Depending on which part of Healthcare 2.0 you're in, there'll be different moats that you're looking for. But in general, high switching costs and intangibles via both the brand value and the patents that these companies secure are what they're going to provide the moat for these businesses moving forward.
As for judging whether or not a company has these attributes, with the switching costs, keep an eye on revenue growth. And some companies will also report a user or slash install base. One of my favorite reasons to invest in medical device companies is because I know personally just how much training a doctor can go through to have to learn a device. And healthcare is a unique market. Once a doctor or a physician gets used to using a device, they often have no economic incentive to switch because it's not them that are paying for the device, it's the patient. So the switching costs can be very, very high. Another thing to keep an eye on is just the intangibles. So does the company have a lot of patents that are working for its favor? When do those patents expire? And many companies can develop a strong brand name in healthcare that can pay off for years.
And our last mega trend to talk about is unquestionably the largest, which is e-commerce. Very simply, this is the replacement of brick and mortar locations to go and buy things for you and your family or your business, and replacing it with a spot on the internet where you can go and buy things for you and your family and your business.
Now, e-commerce has been growing basically since the dawn of the internet, and there was $10 trillion in e-commerce sales that happened in 2020, according to Grand View Research. But that figure is expected to grow to $27 trillion in the next 6 years. And one possible reason for that is businesses are now doing more and more business online. The business-to-business market is still in the early days of transitioning over to e-commerce, but the opportunity here is just massive.
There's so many different players, but again, the big names are Amazon, Alibaba, and JD are two very popular names in China. Shopify helps companies set up an e-commerce presence. Coupang is like the Amazon of South Korea. And then you've got niche players that are focused on one very small slice of the e-commerce industry, like Wayfair for home furnishings or Etsy for handmade goods.
Now, how can you tell if these companies are building a strong moat for themselves? Keep an eye on things like network effect, brand value, and low-cost production.
To know about the network effect, you just look at the number of buyers and sellers. If your platform that you're invested in has lots of buyers, you probably get more sellers, which brings more buyers in, and so on. It's a virtuous cycle. For the brand value, if your site that you're invested in, if that company is the top of mind, it's the first place to go when they need to buy something, that is going to direct a lot of traffic. And if their sales and marketing spend is less than the competition relative to their revenue, that's a good clue that they're doing a great job with their brand value. And the last is low cost production. The thing that they're being produced at a low cost is no longer the goods, but it's really the delivery, and it's a lower internal cost for those companies versus the competition. It takes a lot of spending to build out the fulfillment networks to get packages from the factory to your door in a day's time. And looking at the shipping volumes that companies have is a great way to gauge whether or not they have this advantage.
Now, as we said at the top of the show, these are just 10 mega trends that we think investors should pay attention to, but they are by no means an exhaustive list. I actually keep a running list of mega trends that I have identified, and I've found over 96 that I think are active and counting. This chart here just shows who I think is going to benefit the most from each megatrend. Is it the customers? Is it investors? Is it society? Or is everybody going to bend? Again, as investors, we need to ask ourselves, not only is this industry going to grow, but will the companies that are participating capture a portion of the value they make? Because that is going to be what drives long-term returns. Thank you so much for watching this video. We really hope you enjoyed it. What is your favorite megatrend? And of the 10 we named, is there any that you want us to do a deeper dive on? Please let us know in the comment section below. Brian, thanks for being here.
You bet. See you next time, Brian.